Most income investors are probably in the wrong tier, not because they made a bad decision, because nobody ever showed them the full map. In this video, I'm gonna walk you through all 7 types of income ETFs, their typical yield, the risk profile, and the type of investor each one is actually built for. By the end, you'll know exactly which tier fits your goals and whether your current ETF belongs somewhere else. Level 1, Core Dividend ETFs. This is the foundational tier. These funds invest in established companies that pay dividends and are designed for long-term wealth with a growing income stream. Now, the pros is that it offers diversification. You do get a dividend income and full participation in stock market growth, but there are some cons. And probably the most blaring one is that the yield is really low, 2 to 4%. So they may not provide you with enough income if you're an investor who needs maximum cash flow today. The quintessential funds that fall in this level would be SCHD and VYM. SCHD, of course, is probably the more famous of the two. And if your goal is building wealth first and income second, this may be a level for you. But in my personal opinion, the yield is too low for a lot of investors. And I'm actually one of those investors. The yield is just too low. And now let's go on to level 2. Level 2, Option Enhanced Income ETFs. So these funds still focus on stocks, a basket of stocks, or they may focus on an index, but they also use covered call strategies to generate additional income. So probably the best pro about it is the higher yields. So typically you're looking at somewhere between 8 to 11%, while still offering some long-term growth potential. The biggest con, in my opinion, is because they sell call options, they're going to be giving up some upside during strong bull markets. It's going to be capped. So level 2 would be ideal, in my opinion, for investors who want more income than a traditional dividend ETF, but still want some meaningful exposure to the stock market. So some of the funds that are representative of this level are JEPI, CAIQ, and Goldman Sachs GPIQ. Level 3 is the traditional covered call ETF. Now I have to make a very important distinction because not all income ETFs are covered call ETFs. But of course, all covered call ETFs are income ETFs. And I have to make this distinction because a lot of people have labeled a covered call ETF as such when it's really an income ETF. So unlike level 2, these funds are built primarily to generate income by selling covered calls on their portfolios. So the pros are higher yields, typically around 11 to 14%, and relatively consistent cash flow. The cons, during strong bull markets, those covered calls can cap your upside, so you're going to be lagging the broader market. If your priority is maximizing income over growth, this is where covered call ETFs start to shine. So in this level, you're going to find funds like QYLD, arguably the most famous traditional covered call ETF. But there's others, of course, like XYLD and RYLD. Level 4, Enhanced Income ETFs. So these funds also generate income by selling options, but many use Section 1256 contracts, which basically receive a very favorable tax treatment under the U.S. tax code. So 60% of the gains are taxed at long-term capital gains rates and 40% at short-term rates, regardless of how long the options are held. And some examples of funds like these are SPY-I and Triple QI. So these vehicles are some of my personal favorites because of the tax advantages. And they offer higher yields, typically 11 to 14%, and the tax advantages cannot be discounted. They're very, very important in my opinion. Now, some of the cons, like other option income ETFs, they can still lag the market. during strong bull runs because selling options limits some upside. If you're investing in a taxable brokerage account and want to maximize after-tax income, this level deserves a closer look. Level 5 is concentrated income ETFs. So when I say concentrated income, I'm referring to typically a single stock, or it could be a single sector, like gold or silver as an example. So level 5 is where diversification starts to disappear, because instead of owning hundreds of stocks, these ETFs concentrate on a single stock or a narrow theme. So some examples would be ETFs like TSLY, which focuses on Tesla, or NVDY, which focuses on NVIDIA, or GDXY, which focuses on gold. Now, the pros, very high income potential. And when I talk high, I'm talking about yields from 20 to 50% or more. And it's very aggressive income, but it's also high volatility. And there is definitely a few cons that I'm going to talk about. So it's much higher risk because your returns depend heavily on one company or one sector like silver or gold. So these ETFs are built for investors willing to trade diversification for higher income, and typically are used as tools rather than long-term investments. Level 6 is made up of fund of funds income ETFs. So instead of owning individual stocks, these funds invest in other income ETFs. So think of YMAX and YMAG. And there's a few pros and cons that I'm going to talk about. But first, let's talk about the yield. So first of all, YMAX, which invests in the entire universe of YieldMax, offers a yield of 48.61% as of this recording. And then we got YMAG, which actually is a fund of funds across 7 ETFs within the YieldMax family. And they offer a yield of 36.28% as of this recording. So the pros is that there's instant diversification across multiple income strategies while maintaining a very high income potential. Cons is that you're adding another layer of fees and your performance depends on the underlying ETFs that they own. If you like the idea of spreading your risk across multiple income ETFs with a single investment, this level may be worth considering. Finally, we have level 7, structured income ETFs, also known as exotic ETFs. These funds typically target yields of 14% to 24%. Instead of relying primarily on dividends or covered calls, they use structured products called auto-callables. So, in simple terms, an auto-callable is a financial contract designed to generate income while offering predefined outcomes based on how the underlying investments perform. Some of the ETFs in this category are CAIE, CAIQ, and by the way, I made a video on them, and I'm going to put a link to it at the end here in this video, and CAGE, CAGE. So the pros, it's attractive income potential and a very unique return profile. The cons is that they're more complex than a traditional income ETF, so investors should definitely understand how the structure works before investing. This level, in my opinion, is best suited for experienced income investors who are very comfortable with more sophisticated income strategies. Thank you so much. Here's the link to that video that I promised. Have a prosperous rest of your week. I'll see you on the next episode.